Under the new standards, Sue would be required to respond to this information as the CFO has clearly engaged in insider trading, which would have a substantial impact on public interest. In terms of the new standards, it does not matter that Sue obtained this information from overhearing a conversation and not through the course of performing the audit. So applying step 1, she would need to obtain an understanding of this matter. In this case, Sue would inspect the share register and confirm that the CFO's wife purchased 300,000 shares in the entity and that the date of purchase was subsequent to the date of the board minutes where the confidential merger deal was discussed. She would then need to discuss the matter with the appropriate level of management. Who this is a matter of judgment. However, Section 225, paragraph 17 indicates that the appropriate level of management is generally at least one level above the person involved. So Sue would need to discuss the matter with the CEO or those charged with governance and prompt them to investigate the matter further. Step 2 is for the matter to be addressed. This step requires Sue to advise the CEO and those charged with governance to take appropriate action to rectify, remediate, or mitigate the consequences relating to the insider trading. She would also advise them to disclose the matter to an appropriate authority because this is required by law and considered to be in the public interest. Now, it is important to note here that rectifying, remediating, or mitigating the adverse consequences of the non-compliance is the sole responsibility of management. Sue is only required to advise them to take the appropriate actions. Step 3 is for the professional accountant to determine if further action is required. In making this assessment, Sue would assess whether the response from management was timely, the non-compliance has been adequately investigated, action has been taken to rectify, remediate, or mitigate the consequences of the insider trading, appropriate steps have been taken to reduce the risk of recurrence. For example, the CFO is suspended or his employment terminated. And finally, the non-compliance has been disclosed to an appropriate authority. If the professional accountant is not satisfied with the appropriateness of management's response, then further action would need to be taken, which may include disclosing the matter to an appropriate authority, even when there is no legal or regulatory requirement to do so, and withdrawing from the engagement. If Sue reports the matter to an appropriate authority in terms of this standard, she would not be in breach of her duty of confidentiality. Further, if Sue decides to withdraw from the engagement, she is still required to take appropriate action unless there are specific laws that prevent her from doing so. In Australia, Sue would need to comply with whistleblowing laws addressed in the Corporations Act. To recap, there are basically 3 steps that guide professional accountants on how to appropriately respond to NOCLAR. Professional judgment on the application of these steps is critical.